Welcome to the Deep Dive. We're here to cut through the corporate noise and really get to the heart of what matters. Today, we are cracking open the latest from Eternal Ltd. You probably still think of them as Zomato, right? We've got the primary source stuff right here, the board meeting outcomes, the shareholder letter that includes a management Q&A, which is always interesting, and of course the financials for Q1 Fiscal 26. That's the quarter ending June 30th, 2025. Our goal, pull out the really important nuggets, see the big picture, and maybe find some surprises in these sometimes pretty dense documents.
Exactly. And, these reports, they're more than just numbers on a page. They really give you a snapshot, not just financial health, but where they're headed strategically. It's about the evolution of a huge player in food and increasingly quick commerce. We'll connect the dots for you, focusing on what really tells the story here.
Okay, let's dive right in then. Headline numbers. What's the big financial picture for Eternal in Q1?
Well, at a high level, the top-line growth is, frankly, explosive. Consolidated revenue from operations, it basically shot up by 2/3 compared to last year, hit over 7,100 crore rupees.
And it was 2/3.
Yeah. And consolidated adjusted revenue, that grew a really strong 67% year over year, over 7,500 crore rupees now. They've kept up this 50% plus growth rate for 11 quarters straight. It's quite a run.
Impressive consistency on growth.
It is. But here's the twist, and it's a big one. Despite that revenue surge, profitability actually took a hit. Consolidated adjusted EBITDA down, declined over 40% year over year, landing at 172 crore rupees.
40%. That's significant.
Very. And the consolidated net profit for the quarter was just 25 crore rupees.
25? Compared to what last year?
Compared to 253 crore rupees in Q1 last year. So a massive drop. Basic earnings per share ended up at just 0.03 rupees.
Okay, that really grabs your attention. Huge revenue growth, but profit and EBITDA falling off. So the immediate question is this deliberate, a strategic choice, maybe sacrificing profit for growth, or is there something else going on?
That's exactly the question. And to answer it, we really need to break down their business into its parts. They have 5 main operating segments now. India, food ordering and delivery, which is the classic Zomato business. Then there's Hyperpure, that's their B2B supplies arm. Quick commerce, which is Blinkit. Going out, think dining, events. And then a sort of catch-all other segments.
Right.
And yes, the dip in overall profit and adjusted EBITDA, it largely comes down to them pumping serious money into growing quick commerce and going out. Food delivery margins actually improved a bit, offsetting some of it. But the big story is investment in those future bets. It's definitely a signal. Prioritize growth now, worry about maximizing profit later.
Okay, let's peel back those layers then. Starting with the traditional core, food delivery. Is it still the main engine, the cash cow? Or are things shifting?
Well, food ordering and delivery brought in revenue of 2,261 crore rupees in Q1, and segment profit was 465 crores, so still profitable. Now, their key metric here is net order value, NOV. They're actually ditching GOV, gross order value, saying NOV is a better measure of growth for their B2C side.
Okay, NOV it is. How's that looking?
Its year-over-year growth dipped slightly. It was 14%. Now it's 13% in Q1. Management seems to think this is the bottom, though. They're projecting FY26 growth somewhere above 15%, but staying below 20%. And they hope it trends towards 20% in FY27.
So slowing a bit, but still aiming for solid growth. What about margins in food delivery?
The adjusted EBITDA margin did improve compared to last year, up to 5.0% of NOV from 3.9%. But quarter over quarter, it actually dipped slightly. They put this down mostly to seasonal things, fewer delivery partners available during festivals, bad weather in summer, and the rains impacting things.
The seasonal headwinds. Makes sense.
So they think long-term margin expansion is still on the table, but right now, the focus is just hitting that growth target while keeping margins around that 5% of NOV level. Oh, and on competition. They basically said new ideas and players are inevitable, they make the business stronger, and they don't see any major threats right now.
Okay, interesting perspective. Now let's talk about the segment that seems to have just exploded onto the scene. Quick commerce. Blinkit. What is driving this insane acceleration?
Insane is a good word for it. Quick commerce, Blinkit, it's become a real rocket ship for them. Segment revenue in Q1 was 2,400 crore rupees. Still a segment loss, mind you, 42 crores. But here's the absolutely fascinating part. For the first time ever in Q1, quick commerce NOV was higher than food delivery NOV for the whole quarter.
Wow. Okay, that is a monumental shift. Quick commerce is now bigger than food delivery by that measure.
Exactly. It now makes up almost half of their total annualized B2C NOV, which is pushing nearly $10 billion US. It's huge. And the growth. NOV for quick commerce was up 127% year over year.
127%. How?
Mostly driven by just getting more customers. Average monthly transacting customers jumped 123% year over year, went from 7.6 million to almost 17 million, 16.9 million to be precise.
That's incredible customer acquisition. And they're building stores like crazy too, right?
Oh yeah. Aggressive expansion. Added nearly 250 net new stores in the quarter. They're past 1,500 now, 1,544 total. And they're sticking to their plan. 2,000 stores by December this year. Warehousing is scaling up too, 5.6 million square feet now.
What about the profitability of quick commerce? Still losing money, but is it getting better?
It is improving. The margin as a percentage of NOV went from a loss of 2.4% last quarter to a loss of 1.8% this quarter, which is pretty good actually considering how much they're investing in those seasonal factors we mentioned. They seem pretty confident about long-term profitability. They mentioned some cities are already hitting over 2.5% adjusted EBITDA margin. The long-term goal is 5-6% margin. They expect absolute losses to shrink soon, but maybe not smoothly, because of competition.
So what's their secret sauce for growth? How are they managing the economics?
Their stated strategy is basically keeping it simple. Focus on the customer promise. Speed first, then assortment, then customer support, then price, in that order. And they shared an interesting stat. Revenue per order from a brand new customer is over 100 rupees right from the first month. They claim this means new customer cohorts are already breaking even at a contribution level from month one.
Contribution level break even from month one. Can you unpack that slightly?
Sure. It basically means that once you subtract the direct variable costs tied to an order, like the delivery cost, the cost of goods sold if they own inventory, commissions, perhaps the revenue left over from that very first order from a new customer is positive. So the individual transaction is profitable, even if the overall segment isn't yet because of fixed costs like stores, warehouses, tech, marketing spend, etc.
Got it. Profitable on a per-order basis from the get-go for new users. That's powerful for scaling.
Definitely. And they also talked about their internal culture, this dissatisfied culture and a 1% done philosophy, basically always feeling like there's more to improve, constantly solving problems for customers.
All right, never complacent. Okay, so quick commerce is the star. What about going out? That feels like a very different kind of business for them.
It is different, but you shouldn't ignore it. Going out, which they brand as district, it's smaller for sure. Q1 revenue was 207 crore rupees, with a segment loss of 48 crores. But look at the growth. Over 30% year over year on a like-for-like basis. It serves about 2 million monthly customers who transact about twice a month. And the average order value, much higher. Over 1,700 rupees.
1,700. Wow, compared to food or quick commerce. That's
Exactly. It's a different game. They're positioning it as a platform for dining out, movies, sports, concerts, ticketing for a sort of premium customer base.
Yeah.
The average revenue they get per order is over 160 rupees, again, much higher than delivery or quick commerce. They actually threw out a projection, potentially scaling this to $3 billion in annual revenue with $150 million in adjusted EBITDA over the next 5 years.
So definitely a long-term play, investing now for potentially high-value customers later.
Precisely. It's an investment, but with a clear eye on a profitable premium niche.
Okay, and just quickly, the B2B side, Hyperpure.
Hyperpure Supplies. Yeah, segment revenue was almost 2,300 crore rupees, 2,295 crores in Q1. Tiny loss, just 5 crores. Revenue grew 89% year over year. Big jump. However, they're actually flagging expected degrowth here in coming quarters.
Degrowth, why?
It's tied to that quick commerce inventory shift we'll probably talk more about. As Blinkit starts owning its own stock, it'll buy less through Hyperpure.
Ah, okay, an internal shift impacting segment reporting. Makes sense.
Ah.
And the others segment, what's driving losses there?
Right, all other segments. Very small revenue, 4 crores, but a loss of 45 crores. The main reason for the increased loss here is investment in Bistro. That's their 10-minute food delivery experiment.
Zeus, right. 10-minute hot food delivery. How's that going?
Still early days. They have 38 kitchens running in Delhi NCR and Bangalore. They're targeting what they see as unmet needs. High quality, but low-cost meals, snacky stuff delivered super fast. And they say the early signs are good. It seems to be bringing new demand, not just stealing orders from the main Zomato app.
Interesting. So another bet on the future.
Yep. And they've budgeted for it. Eternal is planning about 150 crore rupees in loss funding just for FY26 across Bistro, something called Nugget, and another initiative, Greening India.
Okay, lots of moving parts across the business. This brings me to how they manage all this internally. I was really struck by this rotational leadership model. Sounds pretty unusual. What's the idea there?
It is unusual and quite strategic. They call it rotational leadership. Essentially, CEO roles within the company are time-bound, usually for about 2 years.
2 years. That's short for a CEO.
It is. The stated purpose is all about agility. They believe it brings fresh energy, stops people getting complacent, speeds up execution, pushes decision-making down, builds organizational muscle memory, and importantly, grooms future leaders to future-proof the company.
So who does this work for? Not every company could pull this off, Charlie.
Right. They themselves say it works best for companies that prioritize systems over individuals, companies that have already found product market fit, operate in fast-changing markets, and really want to develop leaders internally. They explicitly say it's not great for, say, early-stage startups or companies in a crisis.
And we saw an example of this recently with the food delivery CEO.
Exactly. Aditya Mangla is the new CEO for food delivery. He comes from a product and engineering background, and this is apparently the first time in Zomato's entire 17-year history that someone who isn't from an operations background and isn't a founder is leading that core business.
That's a big shift. It sounds agile, but, does it risk losing continuity? Or deep expertise in one area if leaders rotate out after just 2 years, especially in something as cutthroat as quick commerce?
That's the potential downside, right? It's a trade-off. Agility versus potentially losing that deep institutional knowledge or consistent long-term strategic direction from one leader. It's definitely something to watch, how well they execute this as they scale.
Fascinating internal dynamic. Okay, let's pivot to another major strategic shift you mentioned, moving to inventory ownership in quick commerce. This sounds like a fundamental change.
It is fundamental, a real game changer for Blinkit's model. First, the context. Eternal confirmed they are now officially an Indian-owned and controlled company, or IOCC. The foreign shareholding dropped to around 43% as of June 30th, which is below the 49.5% cap required.
And that IOCC status unlocks this inventory ownership.
Precisely. Being IOCC allows them to gradually shift Blinkit from being just a marketplace connecting stores and customers to actually owning the inventory in those dark stores themselves. They plan to do this over the next, say, 2 to 3 quarters.
What does owning the inventory actually let them do differently?
A lot. It gives them much more control, more leverage. They can manage the product assortment better, push new products faster, and potentially capture significantly better margins in the long run because they're capturing the retail margin too, not just a commission. The direct impact you'll see is quick commerce revenue figures will start looking much closer to the NOV figures. And as we mentioned, Hyperpure's non-restaurant B2B business will shrink as Blinkit buys less from it.
And it affects capital too, right? Working capital.
Yes, definitely. Net working capital for quick commerce will go up because owning inventory ties up cash. But Hyperpure's working capital needs will decrease. They've already started, actually. About 3% of Blinkit's NOV in Q1 already came from inventory they own themselves.
Okay, so more control, potentially better margins, but ties up more cash in inventory. How does this affect the return on capital? Let's talk ROCE for quick commerce.
Right, return on capital employed. They're projecting an ambitious ROCE of at least 40% for quick commerce, assuming they hit that 5-6% adjusted EBITDA margin target eventually.
40% ROCE. How do they get to that number?
Let's break it down. They estimate the capital expenditure, the CapEx, for a typical dark store, including its share of warehouse costs, is about 1 crore rupees. Annually, that translates to about 4% of the NOV that store generates.
Or 4% CapEx intensity.
Then there's net working capital, NWC. As a marketplace, it's very low, maybe 3-4 days of NOV, so around 1% of NOV. But if they move to 100% inventory ownership, they estimate NWC will jump to about 18 days of NOV, which is roughly 5% of NOV.
So total investment is CapEx plus NWC, about 9% of NOV.
Exactly. Around 9% of NOV tied up in capital. Now, if they achieve an EBIT margin earnings before interest and taxes of 4% of NOV, which is sort of the lower end of their EBITDA guidance adjusted for depreciation, then ROCE calculation, roughly EBIT divided by capital employed, comes out around that 40% mark. 4%, 9 to 10% of 40%.
That's impressive math, but it hinges on hitting those margin targets while managing the increased capital intensity. A key question for you listening is, can they maintain that efficiency as they scale this up massively? It requires really tight execution.
Absolutely. It's a high bar they've set for themselves.
Now, shifting gears slightly, this Greening India initiative really stood out. It sounds, well, green, but also potentially quite smart financially.
It's very smart. Greening India might seem like just a corporate social responsibility thing at first glance, but it looks much more strategic than that. It's a big agroforestry project they launched in Q1. The goal for this fiscal year, FY26, is ambitious. plant over 2.5 million trees. They're partnering with thousands of farmers, covering 10,000 acres of farmland.
Okay, great environmental impact, obviously. Removing CO2.
Potentially 1.5 million tons of CO2 over 30 years, according to their estimates. But here's the financial angle. This project is expected to generate carbon removal credit certificates, issued by global registries like Verra. And they estimate the value of these carbon credits could be multiple times their initial investment. They're putting in about 30 crore rupees in FY26.
So it could actually generate significant returns through carbon credits.
That seems to be the expectation. It positions them really well for the growing carbon markets. It could turn an ESG initiative into a financial asset. Plus, they can use these credits themselves to help meet their own net zero target, which they've set for 2033. And they mentioned plans to significantly scale up the land area involved in future years. Very forward-thinking.
Okay, let's circle back to the overall financial health. Given all this spending, quick commerce expansion, Bistro, greening India, what does their cash balance look like?
Surprisingly stable, actually. Their cash balance nudged up slightly in the quarter. End of Q1, it was 18,857 crore rupees, up just a bit from 18,824 crores at the end of Q4 FY25.
So they generated enough cash or managed working capital well enough to fund the capex.
Seems so. Total capex in Q1 was 370 crore rupees. About 310 crores of that was for quick commerce stores and warehouses. Another 60 crores went into bistro kitchens and IT hardware. The net working capital did increase during the quarter, mainly because of that Blinkit inventory transition starting, but they said this was partly offset by recovering some ticketing advances in the going-out business. So overall, cash held steady.
Right. Finally, one housekeeping item maybe. There was a mention of an ongoing GST issue. What's the situation there? Potential risk?
Yeah, it's a regulatory point worth noting. The company confirmed that they've received show-cause notices and actual demand orders from GST authorities. It relates to goods and services tax, GST on the delivery charges they collect from customers, technically on behalf of the delivery partners.
Okay. What kind of money are we talking about?
It's not insignificant. One notice covers October 2019 to March 2022 for about 420 crore rupees. Another is for about 21 crore rupees for the following year, April 2022 to March 2023, related to specific states. Now, the company is strongly contesting these. They've filed appeals or are in the process. They stated that, based on their own view and advice from external experts, they believe they have a strong case, but it is an outstanding matter.
Definitely something to keep an eye on for potential future impact then.
For sure. Regulatory outcomes can always move the needle.
Wow. Okay, that was quite the deep dive. We've really unpacked a company that's evolving at breakneck speed. Explosive growth, yes, but also this calculated hit on profits. Quick commerce clearly taking the lead now. And these fascinating new ventures like Bistro and the Strategic Greening India initiative, plus that unique leadership model, lots going on.
Indeed. And if you pull back and look at the big picture, what really stands out is that strategic agility. They're clearly willing to invest very heavily, very aggressively in areas they believe are the future, even if it dents profits today. That shift to owning inventory and quick commerce, the rotational leadership, it all points towards a really bold long-term vision. They're playing to dominate an evolving market.
It really makes you wonder, doesn't it? With that commitment to innovation, that 1% done philosophy you mentioned, always pushing. What other unexpected moves might we see from them? As they keep refining Blinkit and Zomato and exploring these new areas, what stands out most to you, thinking about their strategy going forward? Where might the next surprise come from?